Hey everybody, so our next specific decision is should we lease an item or should we buy it? And so we just got to think of, well, what costs are involved? And obviously, if you lease something, then you've got a rent payment to make. Whereas when you buy it, you've actually got a cost payment to make. But obviously, if you buy it, then you're also going to get, I'll put this in brackets, is a residual value. Put it in brackets to show that that's income as well that we'll have. And that's it really. That's pretty much the differences. Be guided in the question if there are any other differences, such as if you lease it, you don't have to pay for the running costs or whatever. Just put in whatever should be put in. Now, let's just think though finally of tax. Okay, so this is really important. Now, when you buy something, the tax relief that you get, and remember it's good news because it reduces your tax bill, are writing down allowances. Okay, just like you did in MPVs. But then when it's like a profit, and obviously rent payments affect your profit, well, then you're just going to get tax relief because it reduces your tax bill by having an expense. You just get tax relief on that rent payment, okay? And that's pretty much that. So let's do an illustration to put all of that together, okay? So let's say that a machine has a cost of 6,400 and it has a 5-year useful economic life, and capital allowances are 25%, reducing balance, and tax is 30%. Okay, now we can either get a loan to buy the item, and if we get a loan to buy the item, then it's going to be 11.4% before tax. Okay, or we can get a finance lease, so we can lease the item, okay, and we'll pay 1420 in advance per annum for the 5 years. So let's have a look. Which is the cheapest? Okay, which is the cheapest? Let's have a look at buying. If we buy it, then we will have 5 years. We will have a cost. Cost will be 6,400. Then we'll have a residual value as well. I think, or did I give you a residual value? I can't remember. No residual value. So we won't have any residual value this time. Obviously in the exam you would do, possibly, and you put it in year 5. And so that's it. That's all we've got. And so all we need to now put in is the tax. And remember, the tax is the writing down allowances, and they're good news to us. Okay, so we have to work out this tax situation. So writing down allowances, then we start off with an asset worth 6,400. That's its cost, and then we get given writing down allowances as we go on each year. We spread it, so 25% of 6,400 is 1,600. We get that, and that will reduce our tax bill by 30%, which is 480. Okay, and let's say that is, let's say it's all in arrears. Okay, so we'll put that 480 not into year 1 but into year 2. And then if you remember, you can do this quick method. You can just times that by 75%, which will get us 360 in year 2. That times by 75% would give us 270 in year 3. That times by 75% would give us 203 in year 4. And then you can't do that. You can't do the 75% in the final year. In the final year, you have to calculate a balancing allowance. And so what you say is, well, it cost me 6,400. There was no residual value. So I should get 6,400 times by 30%. I should get that in total. So 6,400 times by 0.3 is 1920. So all of this needs to come down to 1920, and so it just means I need to put a balancing figure in there, and that balancing figure we'll call, I think, is about 607, something like that. Okay, let me just check that. So what we got? We got 480, we've got 360, we've got 270, we've got 203, plus the final 607. Yeah, I was right. 1920 then. If we put the 607 balancing figure in. Okay, so let's go put all those figures in to our little MPV over here. So I'm going to put that into year 2, the 480. We're saying it's 1 year in advance. We're going to go up to 6 years. So 480, 360, 270, 203, 607. Okay, and then what we need to do is discount them all down. Okay, now I've run out of room a little bit, haven't I? But anyway, discount them down. The discount rate, I said that it was 11.4%, but I said that was before tax. Okay, we always want after tax. We're taking into account tax at the top, so we need to take into account tax here. So you times that by 70%, and that will give you more or less an 8% discount rate. Okay, so at that 8% discount rate, we pop it all in. So you would discount down, if I just put a little thing there, you would discount down all these figures here at 8%. So that would be at 1 year 0, that would be, even though there's nothing there, 0.926, that would be 0.857. You would multiply that one by 0.794, that one by 0.735, that one by 0.681, and that one by 0.630, all coming from your table. Because I've worked it all out in advance, that gets you, in the end, a cost of 4984. Okay, so if we discounted it all down and you added it all across, you would get 4984. So feel free, obviously, to check it, but trust me, if you multiply all these figures through, you would get 4984. Okay, so now let's have a look and do a similar thing if we lease it. So year 0, 1, 2, 3, 4, 5, and 6. Okay, and if we lease it, we will be making lease payments. And we're making them in advance of 1420. So 1420, 1420, 1420, 1420, that's 4, and 1420. Not in year 5 because it's in advance. Okay, so it starts at year 0. And then we'll make a tax saving of 30%. A tax benefit of 30%. 30% of 1420 is 426, and that would start the same as it would before in year 2, because you take year 1, which is actually day 1 of year 1, year 0. 1 year in advance is actually year 2. So 426, 426, 426, 426, 426. You would multiply all of those through. You would discount whatever these figures all add up to. You would discount them all down the 8 figures that we got earlier. Discount those all down at 8%. And if you did all that, rather than me going through it all, I can tell you that the cost is 4548. Okay, and you can compare that then to, what do we say this one was, 4984. Well, therefore, it's cheaper to lease the item. And that's how you do it, okay? That's how you do the numbers. Let's just have a quick think of what the benefits are of leasing. Remember, it's really easy for the company to get an asset, therefore, by leasing it, rather than getting a loan. Sometimes it's difficult to get a loan to get the money. And it can avoid other complications, such as if you get a loan, the bank obviously often wants some security, or they'll put covenants that you can do this, you can't do that. So sometimes it's just a lot simpler to get a lease Okay, and there's no risk of obsolescence. You can send things back at the end of the lease. Often it's maintained for you, but it can be more expensive as well. Okay, so